Good afternoon, everyone, and welcome to this month's webinar, Insurance Planning for Clients in their 50s and 60s. This is part 3 in a series of 3 about clients in this age range. Today's presentation is going to last about 50 minutes. During that time, you can ask questions on screen, or you can wait until the end, and we will allow you to raise your hands on screen and then unmute your phone lines. The questions that are submitted on screen we will try to get to as timely during the presentation as we can. Today's webinar is being recorded and it will be posted to our website within about a week. Regarding CFPCEs, if you're logged into the webinar today for more than 50 minutes using the email address you registered with, we'll report your attendance to the CFP board, and that process can take up to about a month. So our webinars this year have been focusing on the different types of insurance that are recommended for your clients throughout their lives. And we've focused on Sam and Sally, one couple, as they've aged through the years. So this year, again, they're in phase 3 of their 50s and 60s, and we will continue with them through their 70s next month, and then through to the end of their policies in December. Please keep in mind that as we're recommending specific types of insurance coverage for these specific points in Sam's and Sally's lives, the types of insurance are not exclusive just to that age range as presented, but more a general idea as topics for presentation. So today's presenter will walk us through 50s and 60s clients when it comes time for them to make pension elections and how to help them with their wealth transfer desires. And now a quick second about your presenter. Most of you probably know Keith Maurer, who's known as Low-Load's omnipotent insurance guru. He's been in the life insurance industry for about 40-plus years, and he's been researching and developing insurance products and marketing low-load life insurance solutions. And now, of course, he is our in-house consultant to you and your clients here at Low-Load Insurance Services. Please welcome Keith Maurer.
Thank you, Nina. I hope everybody can hear me. I will try to speak into this little speakerphone that they put on my head. So if anybody cannot hear me or it's very soft and can barely hear me, send me a quick message. But I think everybody should be online by now and hear me. So we're going to focus in on the last part of the people in their 50s and 60s. I think we've milked this baby about as far as we can for 3 sessions on this. And we're going to focus on 2 major decisions that people make. The reason we're going to focus on the first one, which is pension options, is not because that's something that you will work with your clients over and over again, but almost all of your clients have this decision once. And hopefully they bring these questions to you. So while you won't use this very many times, probably only once per client, you may have every client come to that option. The second point we're going to talk about is passing on wealth. And why we talk about that, if you remember from last month, how the majority of the people were using life insurance as their goal to pass on wealth according to various surveys. So let's get into our 2 focus for the last part of the 50s and 60s. While we say 50s and 60s, and I'm going to use an example of people in their 50s, most of the time, to be realistically, we're talking about people in their mid-60s, probably even late 60s, as they focus in on retirement. So pension options. What happens with pension options? Well, when people normally retire from any kind of a job that they have, if they had any qualified plans or plans like that, they usually get to choose should they take a life only. What that means is that they get a guaranteed monthly payment that will stay exactly level for the rest of their life as long as they are alive, and it's based only on the retiree's life. So this is usually the largest amount, what is the largest monthly amount that they can choose because it's based only on the retiree's life, and it stops at the retiree's death. The second option then usually that they focus in on is what's called joint and 100% survivorship. That means that the amount would be lower but stays consistently the same as long as either person is alive. So the idea of it being that you have, as long as you, and most of the time it's a spouse, either one of you alive will get this monthly payment. Then there are other options, and there's numerous options. There's joint in 50, joint in 75, joint in 33, joint in 66, but irrelevant to what the percentages are, this is for the concept, the joint and 50% survivorship, that means that you would have one amount. It would still be less than the life only, a little bit more than the joint and 100%, but it would be one amount as long as both are alive, and then it's usually both. Sometimes it's just as long as the only person that's deaf that they care about is a retiree, excuse me, the spouse. But if the retiree dies, then the amount drops to 50%. So, for example, if you were getting $2,000 a month, and then the retiree dies, the spouse would drop to $1,000 a month. And then some plans may offer you or your client a lump sum. Now, what we have found is that in the last probably 4 to 5 years, 3 to 4 years for sure, the lump sum is a very poor option. They just don't want to pay out lump sums. It's just, you know, you can see that as well as I can. If you take the present value of any of the other options, you would say, well, there ought to be more of a lump sum than that. They just don't want to pay it. So there's no requirement that says it has to be a present value of any number or whatever. So while lump sums used to be a little caveat, say, look at the lump sum and see if you would do a tax-free 1035 to someone else's life only or joint and survivorship, those usually just have not been part of the play lately. Okay, I've hit this thing twice. It's going to go too far for me. Okay. Now, when you choose a joint and survivorship option, your clients are actually buying what I call hidden life insurance. Now, what do I mean by that? Well, when you take a joint and survivorship, the amount that is calculated will be based somewhat on mortality, what's the age of the spouse, the partner, and on and for that there's a cost. So the definition of to my broad definition of insurance is there's a cost that has something to do with the mortality and something to do with the payment based on that mortality. Well, that's what's happening with a joint and survivorship. So there's a form of a hidden life insurance there anyway. So if there is a form of a hidden life insurance, if you'll accept that, then is there a better way of buying that life insurance? So what happens when your clients come and to this point in their life, they agonize over this? What do they agonize over? Should they, come on, little button. Do we take the largest amount, which means life only, and then leave my partner with zero at my death, or, which we really like that bigger amount, by the way, or should we take a smaller amount and then ensure that I leave something for my partner to have some income should I die? That's just a tough question, and if they're wise, they're going to bring that question to you, and that's what you're there for. And so you might as well be prepared to see, what do we do with that? And what we suggest is we're going to organize these. If we take the larger amount, the question should be then is, can life insurance provide the partner with equal benefits? Well, that begs two questions. So how much insurance do I need, and how much does it cost? If I don't know those things, I can't make the decision. So that's how we organize it. So how do we do that? Well, how much do I need? How much do I need? There are probably 1,000 different ways of calculating this, but we sort of do it on a basis that says, if you, come on, little button. There we go. What we use is a single premium immediate annuity. Why do we do that? And I'll tell you how in a second. But single premium immediate annuities do include mortality. Obviously, the amount you get for a single premium basis is based on your age and sex. It does have a multiple of interest rates. It's not only short-term, but it's long-term and intermediate term. And most importantly, it is a guaranteed number. Because what we don't want to have happen is that we make some mistake along the way and then say, oops, I want to change my mind. No, these are all guaranteed. So here's what we do, is that we look at a single premium immediate annuity. We say, okay, how much lump sum would I need? How much premium on a single premium immediate annuity would I need to guarantee the partner a lifetime income? So exactly what would happen. So that if I have a joint in survivorship and I die, then my spouse should have lifetime guarantee income. I know what that income is, and I know my age of my spouse, so I should be able to calculate how much lump sum I would need to guarantee that, and that would be the death benefit. But this amount decreases over time. Obviously, if my partner is 50, I need an amount larger than if my partner was 80. So what we do is we calculate it, we look at what the single premium median annuity would be, and we look at different points in life of this partner, and we usually do that at every 10-year jumps. So let's look at our good old Sam and Sally. And I'm going to make Sam 55, and that's a critical number. We don't get too many 55s, but we do occasionally, and 55 is critical, and I'm going to tell you the answer in advance. 55 is critical because we can buy 30-year term at 55. After 55, we can't get 30-year term. So this is going to be one example, and then I'll show you another example, probably a little more realistic. But Sam is 55 and retiring, and Sally, remember, is a couple years younger. She's 52. And he could get, from one of our other examples a couple months back, with his plans, he could get $3,720 a month on his life only. On a male age 50, that's what you could get. On a joint and 100% survivorship for a male 55 and a female 52, you can get $3,100 a month. That's $620 less per month every month if you take the joint and survivorship option. Okay, let's look at a single premium immediate annuity, which will guarantee that same amount, that $3,100 income for Sally's lifetime, guaranteed. Well, today she's 52. What would be the worst case scenario? The worst case scenario is Sam takes life only and dies in the first year. He gets a couple months premiums and poof, there he goes. What do we need? Well, we would need $600,000 at that point to purchase that for a female age 52, a guaranteed $3,100 a month income, guaranteed for as long as Sally lives. But if Sam lives for 10 years and he is 65, but Sally is 62, what would it take to get a 62-year-old female $3,100 guaranteed for her life? It drops to $500,000. And in 20 years, when she's 72, it's $400,000, and in 30 years, it's $250,000. So those numbers, 600, 500, 400, 250, those will come into play on our next screen here. So hopefully you can see those colors. They're a little tough to see. I think you can probably see, hopefully pretty well, is that actually what happens every year that Sally gets older, every year the amount of death benefit or amount we would need for a single premium goes down every year. But we don't have a policy that follows that line exactly. So what do? Well, we buy $600,000. You see that little sort of greenish yellow, whatever green, I don't know what color that is. It's something other than purple that goes on top there. And so we're going to have a total of $600,000 of death benefit for 10 years. After 10 years, the need has dropped gradually year by year, but if we look at it exactly in 10 years, it's dropped to $500,000. 10 years later, it's dropped to $400,000. 10 years later after that, it stops dropping faster because Sally's getting older and closer to her life expectancy and closer to death. So it drops down to $250, and then it stays relatively level, actually, as far as how much we need. So if you notice, the insurance is stair-stepped because we keep the 10-year term dropping off, a 20-year term dropping off, a 30-year term. But the actual need is a very gradual slope. So by doing this, by buying a single premium immediate annuity and doing it in stair steps like that, we build in some conservativeness. What do I mean by that? Well, the amount that we need goes down every year, but the insurance goes down the steps. So the $600,000 is only needed that first year. But yet we're going to have $600,000 if Sam dies any time in the first 10 years. So we're going to actually have more insurance than we need in every point in time except exactly at the beginning, exactly at 10 years, exactly at 20 years, exactly at 30 years. Every place else in time we're going to have a little bit more insurance than we need, which always gives us a lot of conservative built-ins. Number two is how am I calculating the single premium immediate annuity is based on today's rates. You know, I go over to Jerry actually and say, Jerry, what do I need? And he'll give me the dollar to the penny, but it's based off of his computer that he's calculating the rates today. And I think most people would say that today's rates are low. I can say, the bit of insurance as long as I have, that I haven't seen SBIA premiums based on this low interest rate in the last 30 years. So probably when Sally and Sam dies, probably the rates will be a little higher, so we may again have more insurance than we need. And then there's the cost basis. On the pension plan, all the income comes in usually, has no cost basis, and therefore is 100% taxable. Well, if we take the life insurance and buy a single premium immediate annuity, which we don't need to, we just take the insurance and invest it and let you dole it out over a period of time as you would in other plans without an SBIA. Part of it's going to be principal and part of it's going to be earnings, so some of that is going to be tax-free. So again, while everything is taxable now, with the life insurance as part of the funding, you will have most or a lot of it income tax-free. And by the way, I'm going to do all this because it's so much easier to explain on a just a dollar for dollar basis, not carrying one income tax bracket they're in, and we're not going to calculate that the funds from the life insurance are income tax-free and get them advantage and all that. But we could. You know, if you would feel more comfortable that all the pension max should be done on an after-tax basis, then fine. We can do it on an after-tax basis. It may be more difficult to explain it to your clients, but this seems to be making sense to them, but be glad to do it. So that's not a problem. So let's talk about our strategy. The strategy here is, let's see if we can purchase life insurance on Sam to replace the income stream if he dies, and can we do that for less than he would basically have to give up by taking the joint 100% survivorship, because he can just mark a little box and get lifetime income for his spouse, for Sally, and it only costs him $620 a month to do that. Should we suggest that he goes through the idea of buying life insurance? And the answer would be is, if we can do it for significantly enough less than $620 a month, it may be worth looking at. So how do we do this? Well, we layer these term policies with a guaranteed UL. All these, therefore, all the death benefits and all the premiums and all these numbers are guaranteed. There is no projections on any of this. So if you add up the, right here, I think you can see my cursor, if you add up the 100, the 100, the 150, and the 250, that ends up being $600,000. That's how much we need. We need that if he dies the very first year. How much does that cost us? Well, it's going to cost us $22 a month for the 100,000 10-year term, $33 a month for the 20-year term, $134 a month for the 30-year term, and for the guaranteed lifetime income or lifetime death benefit of $250,000, it's $230 a month. How much does that cost us day one per month? $419. How much did we have to play with? Remember, there was $620. So we have an extra income of $201 a month, or that's $2,412 a year. Looks like a pretty good plan, or at least worth considering. And by the way, we're calculating Sam as a preferred, not a preferred plus. If it had been preferred plus, it would even be more substantial savings. But and a male age 55 has a good chance of being preferred plus. But for right now, we're going to use a preferred. So now that looks pretty good. But wait, there's more. And if you call in the next 5 minutes, you didn't get 2 of these. Anyway, there's more. This is actually, as Sam gets older, lives, and doesn't die, actually we can drop off some of these policies. So what happens? We just went through the process of when he has all his term insurance, he's going to save $2,412 a year. But if he lives for the first 10 years, that first one drops off. Therefore, he doesn't have to spend that $22 a month, and therefore his savings goes up for the next 10 years to $2,676 a month. After that 10 years, that drops off, and he gets more money. He's got $3,072 a month extra. And then after 30 years, that drops off, and he gets Now he's saving $4,680. So it's got sort of a built-in increase, which of course, if he takes a joint 100% survivorship, it stays level regardless of all that time. So the savings it's better as he doesn't die, which is a good deal for Sam too. Now, let's talk about maybe a more real-life case. I changed the name. It's a real case. Their just name wasn't Boomer and Sooner, but Boomer was 64, and Swooner is 63, his wife. And his option, and I'm using to the penny, I got criticized for this here in the office, but I said, hey, it's a real case. This is what it was. He could get $11,869.58 a month. His life only at 64. If he took a joint 100% survivorship, it was $9,856.61 a month, and the difference is slightly over $2,000, $2,012.97. So that's what we had to work with. Now, doing the same thing based on Swooner's age. Swooner is 63, so if we needed that right now, if he dies the first year, we need $1.9 million of insurance to guarantee Swooner her lifetime income. In 10 years, that drops to $1.3 million. 15 years, it drops to $950, and 20 years, it drops to $550. My point being, again, he's now 64. If he's 65, do the same thing. As far as years are concerned, I can't get a 30-year term on this, and I'm looking for steps of at least $100,000. We don't want to screw around with a lot of small policies that doesn't work economically wise. And we also have a significant drop as they get older. It's a faster drop. So those are the amount of insurances that we need. Okay, so what do we need? We need a $600,000 10-year term, and that's going to be $263 a year. 15-year term of $350,000, that's $217. A $400,000 20-year term, and a $550,000 GUO, guaranteed for life level death benefit contract. The sum of that is $1,669, and the difference we had to between the two options was $2,012.97. So we have a savings or amount of money that we don't need to spend out of that full amount if he takes life only of $344. This may help a little bit, and try to show it a different way. If you look at the top line up here, the $11,870. That's a monthly amount that Sam is going, the Boomer is going to get every month as long as he's alive. It just stays level. It doesn't move. It stays right up there. This line down here is a $9,857 a month. He takes at 100% survivorship. That doesn't change. That's pretty much his two options that he is considering. Do I take that number or that number? Now, by doing the insurance, the life insurance, he gets to save, the green part is how much he's going to spend. He gets $11,870. He's going to spend that much, so he gets to keep that much. He's going to keep $10,201 a month for the first 10 years. Between years 11 and 15, he gets to keep $10,464. Between 16 and 20, he gets to save $10,681. And then after the 20th year, he gets to save all but $832 of it, so his amount he gets to keep in his pocket for him and Sally, if she's still around, is $11,038. So maybe that helps to show his other choice is keeping that number exactly, that number exactly. It doesn't ever change, doesn't go up, doesn't make a difference who's alive. As far as the joint 100% survivorship, this one here is that number or zero. So hopefully that helps explain a little bit different. But wait, there's more. Can there be more? I don't know. Yes, there is. What happens if Sally dies first? Well, surprisingly, if she dies first, he doesn't need the insurance anymore. If he took the joint 100% survivorship pension option, however, his amount he would receive stays at the $9,857. There are some contracts that have what's called a pop-up. I've probably seen half a dozen of those in the last 15 years. Rarely do they have that. If it is, you got to give up an arm and leg to do it. So almost always it stays the same. But if he takes the life insurance, the moment that Sally dies, he could stop all the insurance and he could continue to keep the $11,870. And oh, by the way, if there's any cash value in his life insurance contract, he could surrender that and get his cash value back. And so since all the premiums could stop, he could keep the full $11,870 in his pocket. So it's even, you know, there's sort of a, besides having the hidden increases in the dropping off of insurance, if Sally dies, it goes immediately all the way to the top. So when does life insurance work? When is this a good option? Well, there's three things. First of all, the retiree has to be healthy. And by healthy, we pretty much mean he should be in the top two. He or she needs to be in the top two, preferred or preferred plus class. Needs to be a non-smoker. Even if you're a preferred smoker, it doesn't work. By the way, if you take the joint and 100% survivorship, the pension company can't ask any health questions. So they're going to assume just sort of an average 65-year-old, 64-year-old, whatever boomer was 64 male. They're going to assume it's just sort of a typical 64 male. If it was a person in excellent health, the life insurance works, and if it's in poor health, we can sort of take the life insurance hidden cost of the survivorship. And by the way, we need some time to get to life insurance. So while we can do the numbers and calculations, it's not going to do any good because we could say to Boomer was a great idea, but I got 2 weeks to make this decision. Even though we think it could be a preferred, even though we think all these numbers are right, there's always something that can pop up in the underwriting. So if you don't have time to get the insurance, it's just an exercise. You really can't make any recommendations. So let me go down one. I think I'm going to answer one of your questions here pretty soon. When should it be not take the pension option? Well, excuse me, when we should take the pension option. When you take the joint 100% or joint 50, whichever you want. Well, first of all, if he's a smoker or not healthy, I use he because it's a boomer. But if it was Swooner who was retiring, if she's not healthy, if she's a smoker or not healthy, then take the survivorship. If it's a government-sponsored plan, now that's not necessarily trying to be a slam against government. It's only that I have yet to see a government-sponsored plan that this works. And why? It's because the joint 100% survivorship on every government plan that's been presented to me from your clients to me through the LLIS on this thing is that the government plans are, the numbers seem to be designed by politicians and not actuaries. I don't know what tables they're using or not, but there's not that much difference between life only and joint 100% survivorship. So they really, I guess all they need to do is tax us some more if they want to make some more money to pay out to spouses. But the joint 100% survivorship just doesn't make actuarial sense. And if the pension option has a guaranteed annual increase, a lot of these are with government plans. But as a matter of fact, the only ones I've seen have been in government plans. But if they have guaranteed annual increases, then a lot of times the life insurance pension max doesn't work. And let me tell you why. One of the reasons why it works so well, the way we designed it anyway, is that we get a drop-off, we can buy term drop-off, because the amount that we need goes down as the person gets older. When you have a guaranteed annual increase, that amount of decrease is very minimal, so that we can't really layer a lot of term. We need mostly permanent insurance, and if you got to buy all permanent insurance and you can't layer on term, then most of the time it really doesn't work. So if there are annual increases, it's always worth looking at because it could start out so low and there could be such a huge difference. But 90% of the time, if not 99% of the time, if the pension plan has a guaranteed annual increase, then the pension match the life insurance just doesn't work. Just haven't found one that has. So, but again, those are almost always usually government-sponsored plans. So, some of the pluses of what we call pension max, or the idea of life insurance versus taking the joint 100% survivorship or joint 50% survivorship, should be more money in the client's pocket. And hey, we get some that doesn't work. And we tell you that. Say, doesn't work this time. One of the reasons, like I said before, he's not healthy or a smoker. it really works very nice if it's the retiree is a female and the spouse is a male, the partner is a male, because females have lower mortality premiums, and the amount of insurance we need for the single premium for male is lower, so it really works well. But anyway, with life insurance, with the Pension Max, the client is always, at worst even, and is always ahead of the system. The way we design it, remember that little stair step of the dropping off of the life insurance. So at the death, you always have at least enough and usually more. With the Pension Max, the term, because the term premiums drop off, the amount you get to keep goes up, and it has the pop-up option, meaning that if the spouse dies, then they can keep all the insurance. So I have a question here from one of my earlier slides. It says, if the lump sum is available, is that the best option? Well, if it's available, the way to calculate that is know what it is, find out what it is, and then I'd call Jerry, or you can look it up in your system, wherever you get your single premium immediate annuities, and actually put the pension plan payouts in competition with what's available in the open market. Meaning that if you could get a single premium of $1 million, then go and say, okay, if I buy a life only, how much could you buy with $1 million? Compare that to what the company is offering, or joint 100% survivorship. Now, if the amount is extremely high, then you have all kinds of options where if you take a lump sum and don't put it into a single premium immediate annuity, then realize that you will immediately have all the taxes due at that point on the whole lump sum. So that gets a little more complicated. But if there's option to get a lump sum, then consider doing a 1035 into other marketplace SPIAs for joint and survivorship and that kind of stuff, and spread out the tax a little bit. But it's years ago, it used to be that it was a very good option, but recently we just haven't seen it. So questions, those that have popped up, I think we're pretty good shape. By the way, anything that I don't answer online here or live, Dina will actually give them all to me, and I will email them directly to you. So we know who it's come from, and I will personally answer all those questions. So don't feel that you should not answer a question because I'm not answering them online live, but I'll get to it. Now, second big decision, passing on wealth. Probably not at 55, but as they get into their 60, 65, and really considering retiring, passing on wealth comes up. It may not come up in those exact words. They don't think of it that way, but they will say things like, well, I want the house to go to my daughter or something like that. They're thinking about passing things on as they retire. Now, why is this a subject? Well, number one, if you remember from last month, and I said last month that we postponed it for this month, is that of the survey from the AARP of all the retired people, 40% of all the retirees surveyed said that they would use life insurance to pass on wealth. Now, that wasn't put on by an insurance company that was trying to say, hey, don't forget life insurance, and I'll buy you a soda pop if you answer the right question. These are from AARP, and there's no reason for them to mention life insurance unless that's what they really thought about it. So, as an average, 40% of your clients have already got this thought in their mind. They may have not told you this yet, and they may have something in a shoebox that they haven't told you about yet, the old life insurance policy, but according to the survey, 40% of them do. The other thing we talked about last month is the wealthy. The people who you say, well, they don't need life insurance. They got all this kind of wealth to pass on. They don't need that. But yet, of the people who've had 10 million of investable assets or more, I believe it was 93% of them own permanent life insurance. And while the number one reason was estate taxes, which may or may not still be applicable today as much as it was when the survey was done, 10 million it still is, but the second reason was estate equalization. And I'm not going to go too much into that today. I could spend a whole hour just on that. But estate equalization is something like, well, I'm going to leave the farm to Billy Joe, who's really running the farm right now, but to Sally Mae, I don't really have much else to give because I put everything into the farm. And so how do you treat the two children equally without having Sally Mae being part of the owner of the farm? You use it with life insurance. It can be various things that can't be easily divided. It doesn't have to be anything as big as a farm. It can be simply as big as a house, where one child is, they want to have the house, and they don't want the other children or child to have to be part of that or whatever. So they can create an estate to equalize the estate by using life insurance. So a whole nother long subject, not going there today, but I think you get the idea. So 40% of the people do like to use life insurance, say they want to use life insurance, so should they? So why life insurance? I mean, let's face it, there's a lot of other things to use. Why life insurance to pass on wealth? Well, I'd say one reason, tax advantages. Life insurance passes on income tax-free. That means that if you put in $1,000 and then you die and it immediately becomes $100,000, that $99,000 growth is never taxed. It's not taxed as capital gains, it's not taxed as anything, and that full $100,000 passes on income tax-free. Can be estate tax-free if it's set up right, but we aren't going there right now. But so huge tax advantages as far as from premium amount to death benefit amount, all that growth is income tax-free. It is stable. As compared to most other considerations that you use to pass on wealth, such as stocks and bonds and cash of the farm or real estate or whatever, all those values go up and down. And so, die on an up market, I guess, is a prediction of that one. It's predictable. I can tell you what the death benefit is going to be. You pay the premium, and it's going to be this amount in 2099. We know what it's going to be. It's not a guess. It's guaranteed. What I'm considering, what we use here are guaranteed death benefit life insurance contracts. And yes, the guarantee should be asterisk based upon the fact that the insurance company is still enforced and still paying. But there has never been in the life of the United States a guaranteed death benefit that has not been paid in full. Now, I understand that going backwards is not the same thing as looking forward, and everything can happen in the future. But hey, I pretty much, I think I've bet on that one. There's no correlation to other investment alternatives, and that sort of is a point I'm going to bring out later. Just we'll hold on that one for a second. And I'm going to say it is excellent to acceptable rates of return. Now, over the years, obviously, I've talked to many of you and a lot of your colleagues, and this varies over time, but I've asked the question as, what is an acceptable, what are your clients, what is an acceptable long-term rate of return that you would look at for some assets that they want to have to pass on to their children or whatever? What's an acceptable rate of return? And well, it varies a little bit. Right now, it seems to be in ballpark of 5% compounding net after tax. Not before tax, net after tax. 5% compounded every year is an acceptable to okay, good rate of return. So that's sort of, I'm going to use that, because I get it speaking to the mic, I'm going to use that as my rate of return. That's sort of my hurdle. So there's a question that I'm going to bring up at the end. So for the question about is life insurance included in the estate, the answer to that is yes, but I'll talk about that in a minute. So right now what we're going to use is a $100,000 single premium. Why did I use that? Because it's simple for right now. We have, we'll use Sam and Sally for lack of a better name. They're both 65 years old, and they have $100,000 that they want to pass on to they happen to have two children, if you remember from our previous discussions. And they want to sort of pigeonhole that and say, I want to pass that on to my children. So we know that male age 65, female age 65, for a single premium can guarantee for life a death benefit of $562,800. So you put in $100,000, and whenever there's a second death, the beneficiary or beneficiaries will receive $562,800. So let's say that in 20 years this happens. They're both 85 and they both get hit by a bus. Or Sally gets pulled into a bus and Sam slips and falls in front of it. Or tried to save her. Anyway, they die. So in order to make $100,000, $562,800 in 20 years, you would have to compound that at a net after-tax rate of 9% every year compounded, or if assuming it's a taxable and they're in a 28% tax bracket, you'd have to earn 12.5% every year compound from day one. But probably one of them still going to be alive at 85. So they got 90, then they got 95. Well, let's say, there's just not that many people who live to 100 anymore. You can say, sure, I see you guys on TV all the time. They're celebrating their 100th birthday. But hey, you got to look at the whole United States to find those 3 people. So we got this, Sally lives to 100 and then dies. Well, lo and behold, that $100,000, if you compounded $100,000 times 5% net after tax for 35 years, you would end up with right about $562,800. So what's that say to me? It says to me that this is a great rate of return if I die early, and just an acceptable rate of return if I live a long, full life. But acceptable. So what's the cost of permanent insurance? Here's Sam and Sally. They're 55. They're preferred, not preferred plus. And I'll get back if they're not preferred in a second. So do I buy it on him? Do I buy it on her? Do I buy it on both of them? Well, the answer is basically the insurance companies don't really care. The premium differs, but the rate of return is depending upon life expectancy, and males tend to die earlier than females. So to guarantee guarantee $1 million on a male age 65 preferred, if it's a male, it takes $19,185. If you pay that annually, every year, the IRR, the internal rate of return of $19,185 each year ends up being better than 5%, but crosses the 5% factor when Sam is 90. So it's a better than 5% all the way to age 90. For a female, for Sally, the premium is $14,975. You say, well, that has to be a better deal. Well, not really, because Sally's probably going to live a few years longer, and her 5% doesn't happen to age 94. Or let's say we buy a second to die. Now we only have to spend $11,425, and when does it cross 5%? At age 99 or 100. So it's basically, when's their life expectancy? Add a few more years, and that's when it crosses 5%. So males die sooner. If you want the money sooner, it's going to cost you more, but your rate of return is the same at normal life expectancy plus a few years. How about single premium? For Sam, if you want to buy $1 million single premium, it costs $268,000 at one time. When does it when does it get down to 5%? Age 92. It's actually slightly better than the annual. How about Sally? That's going to cost $222,000, and at age 96. And on the survivorship, the single premium is $199,025, and it actually was between 98 and 99. But since 99 is actually like 4.95 or whatever, I put in age 98. Okay. Point being that it just depends on how they want to plan it. They don't have to be single premiums. It's easier to explain from this point of view sometimes when it's single premium. But you can do level pay, whatever. The point is that they have a higher rate of return, net after tax, guaranteed, by the way, above 5% until age 90 for Sam as a single life, or 94 for Sally, and 99 if it's a survivorship. Now I'm going to talk about where I say there's no correlation between other forms of investment. Well, if you had a portfolio, what I have learned from working with many of you over these many, many years is that no one puts all their eggs in one basket. You diversify their investments. You diversify into maturity, diversify in the stocks and bonds and U.S. governments and large caps, small caps, foreign money, everything. I mean, you diversify because you know that there are various pressures. Some things go up, things can go down. So it's better to diversify. Well, there's one thing that you have a hard time diversifying, and that's good old time. It's one thing that you have a hard time diversifying. What did we learn when in Econ 101? You take principal times rate times time equals, I'll call it wealth. Principal you have control over. You can decide how much principal. I don't know where you get it. I mean, you may have to rob a bank, but the principal is controllable. Rate, well, by diversification or by amount of risk you want to take, you can project, predict, estimate, hope for, pray, whatever you do to calculate that rate. But time, you all need time. If you have a big enough principal and a big enough rate, that helps. But if you have a big enough time, we can all get to that wealth. So what happens if the one thing that you can't control in the investment world, which is time, is just the opposite for the other part of passing on wealth, which is life insurance? Maybe this helps. Here is the same couple again. If you take the $100,000 and you compound it at 5% net after tax, you see that $100,000 grow. We don't miss a beat, by the way. We get 5% net after tax every year. Never goes back, never jumps up. It's straight, pretty much goes as we go. And lo and behold, you could say, well, life insurance is not a good deal if they live long enough. I mean, if Sally and Sam live to be 110, then that rate of return doesn't look as good as it used to. Well, that's true. But what happens if they die at 90? Then it's a great deal. So all this is saying is that in planning for passing on wealth, I wouldn't put all my eggs in one basket. I wouldn't put all in life insurance either. But putting part of it in takes the pressure off of the investment world if what you're really looking for is to pass on wealth. So why life insurance? Well, I think it has the best results of short to mid time range. I mean, it's hard to, if they die after 1 year, 2 years, you're talking about 3,000–4,000% rate of return. And even after 20 or 30 years, it's a good deal. High rates of return. So if the results are best then. It's guaranteed versus projected. Every number I showed there was a guaranteed number. They have to pass underwriting, but it's a guaranteed number. And I'm not sure how many of you work with people who are retired or thinking about retiring, but the word guarantee sure sounds a lot better than it did when I was 45. Death benefits pass on income tax-free. The way it's set up today, the way the world is today, even if it's a mech, the death benefit passes on income tax-free. Rates of return are calculable. I can tell you in advance what the rate of return will be 20 years from now, 30 years from now, whatever, if you tell me how you're going to pay for it. And it sort of takes the pressure off. This is when we did our the academy, I think it was last year or 2 years ago, I gave sort of a presentation on that. An individual whose name I won't mention because I didn't ask permission to use his name came up and said, I look at this completely different than you do. The point being that, if I have part of it in life insurance and I know that the rate of return, or I know that that much is going to be there regardless, then the pressure for me to perform every year to make it grow and never go backwards, and yet have it be such that it's a positive performance, it's a lot of pressure to do so. It sort of takes some of the pressure off me as the advisor to do that. By the way, I mentioned the word MEC. A MEC would be like a single premium where you do a large premium larger than, usually single pay if it's not better than exchange would be a modified endowment, which if you took the cash values out, it'd be taxed like an annuity. But even that does not change the tax, income tax free of the, now, how about, hey, there's more. There's just more, there's more. There's the bonuses. First of all, you get to name the beneficiaries. Everybody says, of course you name the beneficiaries. Well, how do you pass on wealth if you don't have life insurance, if you don't have a contract? It's usually a will. How do you create a will? Probably have an attorney. How much do you charge an attorney to say, I want to change my beneficiaries? Probably, I don't know, $150, $200, $300 an hour, something like that. With life insurance, you can change it every day if you want to. It can be estate tax-free. Now, in order to be estate tax-free, there's a little bit extra, couple of other steps in point. First of all, in the example I've been giving, if Sam and Sally own the policies themselves and they put in $100,000 and they die and it becomes $1 million, that $1 million would be included in their estate and calculated for their estate taxes. Now, many of your clients, the old with another $1 million probably wouldn't be in that situation necessarily today. But in order to get it out of the estate, someone other than the insureds need to be the owner and beneficiary. That can be an irrevocable life insurance trust. It can be the child. Those are the two that we normally see. It has to be an adult child. But you can get it out of the estate, too. Now, you have to gift the premium every year, or single premium, or however you want to do it. But so for example, the parents to children, they gift them $100,000. Okay, you can use up the annual gift exclusions, and then you have to use part of the lifetime exclusions, but you gift it. Now the child is the owner, the irrevocable life insurance is the owner, and therefore is no longer part of the estate of the insured because they don't own it, and therefore, and you have a 3-year anticipation rule and that kind of stuff. But it can be estate tax free, contractual. Oh, and by the way, other assets can be estate tax free. I mean, you can put in, you can put in cash, you can put in stocks and bonds or whatever, but in an irrevocable life insurance trust. But the taxes that you have to pay for an irrevocable life insurance trust are quite high very quickly. So the idea that life insurance accrues on a tax-deferred basis and then is income tax-free at death saves a lot of taxes as compared to other ways to get it out of the estate and then pay taxes from the trust. It is contractual, which we've talked about. Why is that important? Well, because the next point, it is contractual. It doesn't have to go through probate. The contract says who the owner is and where it passes at death. Cash needed when it's needed most. When a person dies, if you've ever been an executor of an estate, you know that you eat up a lot of cash. There's just a lot of things that need to be paid in a relatively short period of time, and it takes all the pressure off of what do I sell? Do I cash in this government bond? Do I go sell some IBM stock? Do I sell the farm? You know, where do I get the cash? Well, life insurance, that's sort of peace of mind and legacy. I'm going to come back to both of those. And guaranteed minimum, what I mean by that is the contracts I talked about are guaranteed contracts, guaranteed premiums, guaranteed death benefit. You know exactly the amount that's going to be there and what rate of return. The peace of mind and legacy. This is not the first time I've actually given this talk, by the way. Some of you may have heard it before about the idea of using life insurance to pass on wealth. And many times I do use a single premium, even though a lot of times people don't do it that way, but have used a single premium. And what has been interesting to me has been the number of advisors that have come back and asked for quotes and asked for calculations of various amounts of single premium for people older than the advisors. And sometimes, if we ever get far enough, we find out it's their own parents. This is a legacy for themselves. And to talk to their own parents about the idea of using some assets that are going to eventually be passed on and to use life insurance. So it's a thing that has appeal to the person who's retiring, and we found out that some that has somewhat of appeal to the person who's going to be the beneficiary as well. So there's some extra bonus benefits of why using life insurance instead of investments for the tax. So that's sort of the end of that presentation, and I've only got a couple more minutes, but I do want to say there's a couple of new things that are going on. Next month, I'm not sure, but Kathy's going to be announcing that on disability, there's some additional protection that we can use for people on student loans. That'll be unveiled next week. September is Life Insurance Awareness Month. You will probably see a lot of ads, a lot of stuff on television, all that kind of stuff. Yesterday was our LLIS's 15th birthday, And I do want to thank those of you who have sent us well wishes and that kind of stuff. And as you probably know, if anybody called in, we weren't open yesterday afternoon, so we celebrated. And do check our news you can use in our newsletter. For those of you in NAFTA and are planning on being in Philly in a couple, 3 weeks, Judith and Mark will be there. And Mark is speaking to the Genesis Social as well. And a lot of things changing on long-term care. Genworth is now back in California. So a lot of things are going on there. Here's our future webinars. We have one once a month. Next month is Sam and Sally are going to be in their 70s. And then in November, Jerry's going to be talking about annuities and some of the things you can do for retirement. And then in December, it's sort of a catch-all because we've had some of these great questions on all these various seminars along the way. We're just going to sort of bunch them all up and put it into a whole presentation of hodgepodge. It's hard to say exactly what all we're going to do, but we do know some of them is going to be talking about the wrong kind of beneficiaries gone wrong, and that kind of stuff. So, excuse me? And the end of the policy, the end of the life, end of the real thing. So, other thing I'll go into, other than, I would go back to that one, we do sponsor you all. I think everyone that's listening belongs to one of these groups, and we are proud to be a sponsor and glad that we can be of service to you. And thanks to you, we've had 15 nice years too. So it works both ways. Thank you very much. And with that, I guess I've come to the end of my presentation. Are there any last questions? I'm going to look at one real here. Is there an age beyond which pension max strategies would not work? Thinking of people who work longer and didn't start their pension until later until they retire. No, actually, unless the only thing that would happen is their health changes, is that the older they are, the better life insurance works for pension max because the amount we need is less because the partner usually is older too. And if they can buy life insurance, it's a good deal. So it probably like 85 would be too old for a pension max, but people in their 70s instead of 65 works well. Like I said, the trick on that one is, are they still healthy? They still have to be probably a preferred. If they're only a standard, it's just probably worse and probably not worth the effort to go through. So, and if anybody wants to raise their hand, I can turn off I can demute you, but I'm looking at those that have put it on. I'm not going to talk about community property states here. I'll answer that one online. So I think that's about the only question I'm going to answer here online, and I've come to the end of my hour. Thank you again for everyone that was here, and because I probably won't talk to you much between now and after Thanksgiving, let me be the first to wish you a happy holiday. Thank you very much.